Here to talk to you today about CleanTeq's Sunrise project. The disclaimers for today. This is a project in your backyard. Barry just told you about the potential of the Macquarie Arc in central New South Wales. Well, this project sits right on the Lachlan Fold belt of the Macquarie Arc. It is 100% owned by CleanTeq. It's one of the world's largest nickel cobalt resources in the world. And for that reason, it's a very strategic asset for electrification and the automotive supply chain. It's a big resource. It's a 40-year mine life. It'll be lowest quartile operating cost once in production. And the objective here is not to produce any metal. It sounds strange from a miner, but we are here to produce battery-grade chemicals for the battery industry to service battery packs for electric vehicles. It's one of the most advanced projects in the world. We've completed a definitive and bankable feasibility study. All the key permitting is completed on the project, and the engineering, which has been underway for the last 18 months in China, is now for early phase engineering complete for all intents and purposes. We're now in a process of raising money, equity for the project, but it is one of the near-term development opportunities that the electric vehicle industry has. And you can see on the picture there, it's probably in the most ideal place to develop a mine, flat, no local population, and it's well serviced by infrastructure for the mining industry. You've had a lot today on the battery market, but let me just give you a very quick overview of how we see the market. Here I've presented, according to scale, the size of markets globally. The world's oil market is the world's largest product market. It's about a $2.5 trillion market. In contrast to it, I've put on the right there all of the world's metal markets combined to give you a sense of how large this oil market is. In green, I've highlighted those metals which are most exposed to the electrification theme that Barry just talked about in our global economy. Copper, obviously, both as a source of transmission infrastructure, but also an integral part of batteries. Nickel, cobalt, lithium and graphite are also there. The key point to note from this sort of presentation of markets is that if the world needs to electrify, and it is doing that rapidly and it will continue to do so, it will become a much more metals intensive world. Mining needs to expand at a rapid rate to be able to cater to the electrification of the grid and transport applications. I'm always loath to put up projections for electric vehicle sales because there are so many out there, and frankly I don't have any clue what the future holds. I can make some assumptions and some guesses, as many analysts do, which is what the left graph shows. However, of more interest to me is the graph on the right, which shows an extrapolation using data from invested capital. And what the graph on the right shows is given the over $100 billion of invested capital that is already either in construction or committed to EV development or battery plant capacity, how much nickel and cobalt is required to service that capacity that's being built today or is committed to. And the point here to note is that lithium-ion batteries, lithium is a misnomer. They are actually nickel batteries. Nickel and cobalt makes up the vast bulk of the value of the battery, about 80% of the cost of the raw materials that goes into the cathode. But you see here that if we had to service 100% of the nameplate capacity of all the battery production plants that are being built in the world today, we need nickel to move from about 50,000 tonnes a year to about 1 million tonnes a year of consumption, and for cobalt to move from about 50,000 tonnes to about 280,000 tonnes. Now, to put those numbers in perspective, the world total nickel production today is about 2 million tonnes, so we need to find about 50% of current capacity over the next 10 years. It's worse for cobalt. That 270,000 tonnes is about 200% of current global capacity. So the challenge for mining is significant. Nickel is the best performing market on the LME today. It's up 66% year to date. The thing I can tell you about that is it has absolutely nothing to do with electric vehicles. The nickel dynamic around pricing has everything to do with stainless steel and what is happening in Indonesia and China. Indonesia has reimposed an ore export ban, which has meant that prices of nickel have risen quite substantially on the assumption that about 250 million tonnes of nickel supply are coming out of the market. And that's really a function of Indonesian policy to encourage Chinese stainless steel industry to build stainless capacity in Indonesia. The interesting thing about that, though, is that as electric cars become more mainstream and an actual physical demand for nickel starts to appear, you're going to see a demand for nickel appearing in a market that is already very, very tight due to these dynamics that are taking place in stainless steel. And interestingly, China already has 4 or 5 high-pressure acid leach nickel cobalt projects in development in Indonesia today. They see a market that will tighten very, very quickly, and they're moving very fast now to see development in Indonesia. How does this translate to the demand for nickel metal, the demand-supply balance? Well, nickel's inventories are shrinking very quickly on the LME. And there's a distinction here between grade Class 1 nickels, which are required for battery production, and Class 2 nickels, which are higher impurities and are fine for stainless steel production, but can never be used for battery production unless they're incentivised by a high enough price. The graph on the right there shows what the gap looks like in terms of supply versus demand. There is a very significant gap coming in nickel. If you think of all the battery raw materials, the supply chain is most exposed by a long way to nickel and nickel supply over the next few years. Lithium is a very geologically abundant mineral. You can find lithium anywhere in the world almost. It's not capital intensive. Nickel laterite, by contrast, is extremely capital intensive. It takes a long time to bring new projects to market, and you're looking at 5 to 10 years at best in bringing new major supply to the supply chain. Cobalt has different considerations. The biggest issue with cobalt is that 70% of the world's supply comes from the Democratic Republic of Congo. That makes automotive manufacturers very, very nervous about the supply chain and how to secure that supply. It also raises issues around auditability because there's a large artisanal supply component that comes from the Congo, which involves child labour that needs to be managed and monitored. However, the biggest challenge for cobalt doesn't relate to its location or humanitarian issues. It's just the simple fact that 95% of the world's cobalt is byproduct. It does not respond, supply does not respond quickly to pricing signals. So, in fact, most of the world's cobalt will be dependent on nickel and copper pricing over the next few years. Changes in the DRC around taxes and its legal regime has shifted the cost curve up significantly. And that's had a big impact now that, as you might have heard earlier this morning, Mutanda, which is the largest cobalt mine in the world, owned by Glencore, will enter care and maintenance at the end of this year. That takes almost 30,000 tonnes out of a 120,000 tonne market out starting next year. And that's not just due to market conditions. The geology in the DRC is changing quite rapidly as well. That's making extraction of cobalt quite difficult. Following Mutanda's closure, this is what the supply-demand balance for cobalt looks like over the next few years, and as you can see, some very, very steep deficits coming. Cobalt markets will probably be well balanced out to 2022, the next couple of years, but beyond that, it's very hard to see where you're going to see large-scale new production, particularly as most Western investment in the Congo has been disincentivised by the fiscal regimes. Boss Mining, the hydroxide projects, Katanga, Tenke in the DRC, all of these projects are having problems one way or another. So let's talk a little bit about Sunrise and what sits in our backyard here and how it might help solve some of the problems the supply chain is facing. Sorry about how small that bottom graph is there, but this is a project that sits in on the Lachlan Fold Belt of the Macquarie Arc. It sits between Parkes and Forbes and Condobolin. It's surrounded by good quality mines like North Parkes Mine, Cadia, Lake Cowell that Evolution own. So it's an area that's well serviced with rail, good power and water infrastructure, roads, and a very skilled workforce in mining. It's only 350 kilometres west of Sydney, and it's, the resource here is very well situated to think about downstream processing. So don't think of Sunrise as a metal delivery project. The idea here is that forms the basis long term for producing both battery precursor and battery cathode for the global battery market. Why is this a unique geology? Well, I've tried to demonstrate on this graph Sunrise on the left in grey, measuring its cobalt to nickel ratio, and I'll explain why I've done that, against in the red all of the operating nickel laterite projects in the world today. So Ramu and Papua New Guinea and Batavi, these aren't development projects, these are operating assets. These are the best laterite projects operating in the world today. The reason the cobalt-nickel ratio is so important is that laterite projects for their economics depend extremely heavily on the byproducts they contain. At about $21 per pound cobalt, our cobalt revenues pay for almost all of our operating costs. In other words, we're a zero-cost nickel producer at about $21, $22 a pound cobalt. Now, cobalt prices today, albeit they're off their very high highs from last year, are at about $18.50 a pound. So we're not far off actually being a zero-cost nickel producer at today's depressed cobalt prices. You can also see the picture there of the ore. It's solid. Most laterites are clay-hosted and very wet. And there's a significant quartz veining which allows us to upgrade it. It's also a very low acid consumer, which is an important part of your operating costs. But by any measure, this is an extraordinary lateritic resource which doesn't have any real geological analogue anywhere in the world today from what is being produced from nickel and cobalt mines. How big will it be once it's built? Well, that's where it will rank on the list of nickel sulfate producers on the left, sort of 5th largest in the world. But it's, as a project, we're building about another 30 to 40% of additional capacity that could be easily expanded, both in the autoclaves at the front end and the refinery in the back end. So we could actually expand this relatively quickly if the market required it. In terms of global cobalt production, as I say, that large slice for Mutanda on the right there, that'll be in care and maintenance as of next year. But it'll rank in the top 5 or 6 cobalt mines in the world. Just notice though where all the top 10 at the bottom come from. They're all in the DRC except for Sunrise. This is the cost curve of the nickel industry, and part of it can be distorted by byproduct credits, so this takes account of byproduct credits in the nickel industry. You can see it's a relatively flat cost curve except for the 90th percentile where, as you would expect to see, a very sharp uplift. But that blue line at the bottom is our cost of production at a $30 cobalt price, which is roughly long-term projections for cobalt. It's a negative cash cost producer at minus $1.50 a pound nickel, which puts it very, in the bottom quartile of this cost curve. It will be extremely profitable. Our bankable feasibility study was completed last year. Strong production, about 20,000 tonnes of contained nickel and about 5,000 tonnes of contained cobalt. An NPV of about $1.4 billion US with an IRR of about 20%, 40-year mine life, and producing nickel sulfate and cobalt sulfate directly at the mine site. It'll generate about $350 million of EBITDA a year on average over its first 10 years of operating life, and it'll cost about $1.5 billion US to build. In your backyard you have the largest greenfield development project in the mining industry for base metals here, and it'll have a transformative impact on both Australia's battery materials industry but also regional New South Wales. As I say, very low operating costs, and auditability is absolutely critical for the supply chain. Where are we in terms of our development? We are, as I say, it's about a $1.5 billion build. Roughly 50% of that, maybe slightly more, will come in the form of a conventional project debt facility. The project debt markets, I think, are going to be very supportive of this project longer term. It'll generate very strong cash flow into what will be a strong metal price environment. Which leaves us somewhere in the order of $500 to $600 million US in equity we need to raise. We announced about 6 months ago that we've appointed Macquarie Bank to run a process for us on the equity side of the business, and that process will continue out till the end of the year. There's been extremely strong interest all the way up and down the supply chain, from automakers all the way back to miners in that process. To date, about $200 million has been invested in this project before we've even got to the starting line of building it. That's pretty typical. but that's about the equivalent of our market cap today. So in summary, what do we have in this project? We have a large, low-cost, long-life mine. It'll operate for many decades in central New South Wales. It'll be producing products that can be fed directly into the battery industry. It'll be an extremely fast-growing market. It's in one of the safest mining jurisdictions in the world where the supply chain is looking to invest, and it is being built with a very experienced team of developers. So to us, Sunrise is transformative. It's transformative for the mining industry. It's transformative for New South Wales. And hopefully it will be a foundation for how, in New South Wales at least, we can build a domestic battery industry for the long term. Thank you.